Disney is scheduled to report quarterly financial results before the markets open on Wednesday, February 5th, 2025. That has investors asking if they should buy Disney stock before it announces quarterly earnings. I'll answer that question in this video. I'll also preview what investors should look out for from Disney when it reports its quarterly results. That's a lot to cover in this short video, so let's get into it. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. Disney last updated investors on September 28th, and they gave a great investor update that has sent the stock price higher since then. The company reported that it ended the quarter with 174 million streaming subscribers, which include members in its Disney Plus core service, Hulu subscriptions, and more than 120 million Disney Plus core paid subscribers. That was an increase of 4.4 million over the previous quarter. Now, yesterday we got results from Netflix, and the company reported a record quarter in streaming additions, over 13 million streaming subscribers added. That is good news for Disney and Disney streaming segment. That means consumers are even more aggressively switching to streaming connections. I've been saying this for years. Streaming is so much more convenient than the legacy options, and consumers are more and more every day switching to streaming. I don't think that trend is ever going to reverse. It just offers such a big advantage. Disney also benefits from the leadership of Netflix and Netflix's strategy. Remember in 2019 when everybody and their cousin wanted to launch a streaming service, and that was only accelerated in 2020? There was all these streaming services coming in to compete against Netflix, and Netflix, as the leader, didn't panic and didn't cut prices and create this whole industry downtrend. Instead, what Netflix did, rely on its core competencies, rely on its advantages, and actually raise prices over the coming years. And that created a robust environment for streaming content providers. And the others took Netflix's lead, right? Netflix raised prices, everybody else started raising prices. And I talk about this a lot with all of the industries that I cover. And the opposite of this is happening in electric vehicles, right? The opposite happened with Tesla as the leader of the electric vehicle industry. And then all the competition started coming in 2020, and Tesla panicked and they cut prices and they slashed prices and they offered incentives to everyone. And that created a whole industry downturn. And today, I believe it was this morning, we had yet another announcement of an electric vehicle company going bankrupt. And so that whole industry is on the downtrend because the competitive environment is fierce and getting worse. You don't like to invest in situations where competition is intensifying. That's bad for investors. In this situation, the streaming industry, competition is easing, right? Netflix yesterday announced yet another price increase. That's going to make the whole industry more profitable because that leaves room for others like Disney to raise prices themselves. Another big thing, Disney recently announced a deal with Fubo TV for its live TV services, combining it with Hulu's live TV services. We're going to want to hear more details about that relationship in the upcoming earnings release from Disney's perspective. Why did they enter into this deal? Why did they agree to this deal? And then a week later, they shut down that partnership with the other studios to launch the sports first streaming service Venue. So we're going to want to hear more about that when the company reports its quarterly earnings results. All right, the experiences segment is where Disney reports results from its theme parks, cruise ships, hotels, etc. That segment has been thriving ever since the economic reopening around 2022. People have spent more money and more time away from home, and that's benefited Disney significantly since 2022, and that continues today. Although that trend is not as strong as it was in early 2024. It started to taper off a little bit as consumers are getting exhausted with the higher prices. I mean, if you've taken your family to Disneyland or any one of Disney's parks, I don't need to tell you about how expensive it is. And people continue visiting these parks, although the growth is not there anymore in terms of attendance, right? Disney said that the domestic parks, the operating income increased in the fourth quarter, but attendance was comparable, right? So that means it's not because more people were coming to the parks, it was driven by higher guest spending. So people are spending more money at the parks. It's not that they're getting more visitors in the parks, it's that existing visitors are spending more money. And it's not really by choice, it's because Disney has raised the prices on almost everything from the ticket prices to parking to food to the fast pass access, almost everything, the price has increased. So same attendance levels, just everyone has to spend more money because they increased prices. But the good news for investors is that even though they're increasing prices significantly, the attendance is still elevated. It's not going down, it's just flat compared to last year. I take my family to Disneyland all the time, and I can tell you, we've never gone to Disneyland where there isn't lines everywhere. I mean, everywhere. There's a line to get into the park to pay for parking. There's a line to go on rides. Even if you want to buy a $10 bucket of popcorn, there's a long line. If you want to pay $5 for a 20-ounce soda, there's a long line. There's lines everywhere. And so even though they're charging higher prices, people are willing to pay because of what they're getting in return. They still feel like they're getting a good value in return. So looking ahead, Disney is forecasting high single-digit earnings per share growth in 2025 and $15 billion in cash flow from operations. They're also forecasting double-digit increases in earnings per share for 2026 and double-digit growth in cash flow from operations in 2026. They're also forecasting double-digit growth in earnings per share in 2027. So Disney is very optimistic about its growth prospects over these next few years, and that's fueled by the growth in the streaming segment, which is now profitable, and that will continue to be so. The growth in streaming, as I highlighted in the beginning, is accelerating. People are now switching over by the millions, and that switch from cable is accelerating. All right, Disney stock is now trading at a forward price to earnings of 18. It's still relatively cheap. And you might be thinking, well, you just highlighted all of these great things about the business. Why is the stock cheap? The one thing I didn't talk about is the big thing that's hurting Disney is the other side of that, is because Disney still has a meaningful percentage of its revenue and operating income coming from the cable division, from the legacy entertainment division. And so it's not just that it's benefiting from streaming growth, it's that it's benefiting from streaming growth, but it's also losing money from the cable division. And that loss is accelerating. So it's transitioning. It's going from profits from this segment to profits from the streaming segment. So it's not just a clear win for Disney as it is for a company like Netflix. And so that's why you see this depressed valuation for Disney. And when I did my discounted cash flow model, I came to the conclusion of an intrinsic value of $119 per share for Disney stock when the current market price is $109 per share. So both cases, it looks like Disney stock is relatively undervalued. Now, to answer the question, should you buy Disney stock before earnings or after earnings? I don't feel like the stock is undervalued enough where I would say, yes, buy all of it before earnings. But I do have the stock rated as a buy. I like the value compared to the price. You can buy half before earnings and half after earnings. That way you reduce the risks of both sides. You reduce the risk of missing out and you reduce the risk of losses following an earnings release. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.